this is a time to actually invest more into equity because it has become a contrarian market. Investing is not arithmetic, which means that you'll keep making mistakes. Does silver pay dividend? Answer is no. Does silver pay interest? Answer is no. Can you judge silver on the basis of PE? The answer is no.
Hello folks, our guest today, he needs no introduction. Everybody knows him. Everyone respects his view, whether they agree with him or they don't. He's one of the best minds in finance today. We have S Narin of ICICI Mutual Fund with us in the studio today. But before we get into the podcast, there's one thing I just want to highlight. In this episode, we will be discussing investing frameworks. These frameworks can help you manage your money better. This is something that will be useful for you for years to come. So I would suggest that you either bookmark it or save it somewhere where it will be easily accessible for you in the future. So let's start. Welcome, Naren.
Thank you for inviting me to your podcast.
So we have divided this conversation in two parts. First, we'll touch upon the latest developments in the economy and markets that everybody is talking about. And I'm sure that everyone is very eager to know your views on things that has been happening in the markets. Then we'll go deeper into the heart of this episode, where we'll discuss the frameworks. So starting just 2-3 questions is about the current happenings. So Naren, in recent interaction, you have said that interest rate cuts and GST rate cuts for sectors like two-wheelers, autos and FMCG, it could unleash a massive economic boom. So now we have all these things in place, right? How do you see this playing out over the next few quarters?
I think clearly it's going to give a boost to the consumption side of the economy. It's going to give a boost to earnings. And we are going to see that from now onwards for the next few quarters, that we are going to see a pickup in earnings growth in many parts of the economy. And this is something that we wanted and has happened. So we are very happy with what has happened.
Okay. But interestingly, we haven't seen the markets responding cheerfully for it. We've seen some positive movements, but not as much as we would like to see. So being a market participant, just wanted to know what's market waiting for right now?
I don't know. Actually, if you look at it, what has happened is India has become a contrarian market. India is never used to being a contrarian market. Normally, India is the market which does the best in the world. Instead, at this point of time, India has been the market which has performed the worst the last 1 year. If you compare India against China, India against Korea, India against Taiwan, India against Japan, India against US, even India against Europe, India seems to have underperformed all the markets. So India has become a contra market. What is the reason for it? I think 1 year back, the valuations had become too high. And that was a problem. And in recent periods, I think, the 50% tariff on Indian goods to US has been seen as a problem. And that has really affected sentiment towards India. So that's the reason India has become a contrarian market. And in our view, contrarian markets are interesting markets, which means that you have to put more money into equity. And we have always believed in contrarian investing. And therefore, this is a time to actually invest more into equity because it has become a contrarian market.
Okay. So when you're saying it's contrarian market, can you describe a bit about what exactly is a contrarian market?
See, a contrarian market for me is investing in any asset class which has done very badly, relatively at least. I would be very happy if the asset class is both cheap and has done relatively badly. But unfortunately, India is not cheap. India has done relatively badly. So if you compare Indian equity market performance against, let's say, any country in the world at this point of time, the market has done pretty badly this year.
True.
So we call it contrarian because India has done badly against all other markets this year. And you'll be surprised to know that the last 3 years, If an Indian investor had invested in Japanese equities, you would have got better returns than if they had invested in Indian equities.
Okay.
So normally you don't associate Japanese equities with returns. So you can see that India has become a market which has done badly relative to many other markets in the world. That's why we call it contrarian. Which is the best market to invest very big money, is a market which is both contrarian and cheap. Unfortunately, India is contrarian but not cheap. So because India is contrarian but not cheap, you can put money, but you can't put mega money, because if it had become both contrarian and cheap, then it would be fantastic. But it is not contrarian and cheap. It is contrarian and not cheap.
So does that mean whatever you have been saying, at least for some time now, that investors need to temper their return expectations from medium to long term?
They need to temper, but at the same time, I think there is no point in keeping money only in cash. And in Indians, they have been investing in equity. So I think they need to do asset allocation and invest money in equity. I think the problem at this point of time is FIIs have been taking money out of equity. I think it is the FIIs who have to consider whether they are right in being so negative on India after a big negative move, whether they should be so negative on India. That is a question that I think it is the FIIs who have to be a contrarian and who have actually chosen to stay out of India, and they should consider whether they should consider investing in India. I think they are the people who need to change their thought process. Indians have been continuously investing in equity, and I think Indians have to continue their asset allocation and not invest all their money in equity. But it is the FIs who have become underinvested in India, and they need to think whether they should become more positive on India.
Absolutely. In fact, I've watched a lot of your interviews for this podcast, and I remember you mentioning that FIIs have stayed away because Indian markets relatively were very expensive. And now, with all the reforms in place and Indian markets not doing well, and as you said, that it's a contrarian market, let's hope that they do come back.
Exactly. I mean, I think I think even if they don't come back, I think if Indians continue to invest over the next 6 months or 1 year or 2 years in a asset allocation framework, by investing in hybrid fund, I think they would be doing the right thing. I think, Indians make too much about whether foreigners invest or not. As long as they don't overinvest when the market is too costly, it is fine. I don't think we should bother whether FIs are investing or not investing.
True, true. Now, coming to the central theme of this podcast and talking about frameworks, I want to start with something that you've always mentioned, that investing is very simple, right? But if I look at the number of funds, the strategy, and the way this entire whole financial market is structured, it can be very overwhelming for investors. So, how do you reconcile this with the philosophy of simplicity?
See, everyone thinks investing, we have all grown up doing arithmetic. And people think investing is arithmetic. So one of the biggest things that we have learned is that investing is not arithmetic, which means that you'll keep making mistakes. That is the first thing that we have to remember, is that investing is not arithmetic. So when it is not arithmetic, what is the solution is that you practice asset allocation. Once you practice asset allocation, half the battle is over. What is practicing asset allocation is very simple. First, invest in all the asset classes. Second is invest in the asset classes which have done very badly. So if gold and silver has done very badly, put money in gold and silver. But if gold and silver has done too well, don't put too much money in gold and silver. If residential real estate has done very badly, put money in residential real estate. If equities have done too well, don't put all your money in equity. So what is asset allocation is very simple. It is investing more money in the asset class which has done badly, and taking out money from the asset class which has done very well. That is simple. But is it easy to do? No. What does it mean? It means taking out money in 2007. It means that after 2008, Lehman debacle, putting money in equity. It means in 2020 COVID, investing aggressively in equity. Did locals invest aggressively in equity in 2020 or 2024? Answer is no. They invested much more in 2024. In 2001, after the World Trade Center bombing, markets had become very cheap. That was the best time to invest because past returns had become very low. But at that point of time, no one invested in equity. So asset allocation is investing after bad past returns and taking out money after very good past returns. Is that simple? Answer is yes. But is it easy to practice? The answer is no.
True. In fact, that's one of the questions I wanted to ask you. One framework that you have for asset allocation and investing is looking at past returns and then deciding, right, where to put money. So can you explain in terms of what kind of returns can investors look at? How do they make this a framework that, okay, gold has done well, so I will not put it here, which is the asset class that has not done well. I remember again from one of your podcasts, it was, let's say, office spaces. So let me put money here because I have seen X number of returns. So what is the kind of framework roughly one can look at here?
See, you put debt as an asset class, put equity as an asset class, put gold as an asset class. Let's say put silver as an asset class. And just put what was the 1 year return on all the 4 asset classes. Today, if you look at it, gold has delivered the best returns, gold or silver, one of them. Then you have to be very careful. Choose the asset class which has done the worst. Put money in that asset class. And similarly, if you go back to 2 years back or 2 years back, you'll find that silver had done the worst. So at that point of time, it was very easy to say, put money in silver. Go to the year 2020, just after COVID. Go and look, you'll find that equity would have done the worst. So where do you put money? Equity. So simple. It requires simple arithmetic, and then based on that simple arithmetic, find out the asset class which has done the worst and put money in that asset class. And keep putting money in the asset class each year which has done the worst. That is the simple way to invest in our opinion, but very difficult to practice because you are most of the time investing in what is considered unpopular and that people find very, very difficult. Go back to 2013, real estate had done well for 10 full years. So people thought that real estate is the best asset class. For the next 7 years, real estate did badly from 2013 to 2020. In 2020, real estate and equities were very attractive. Both were attractive at that point of time. You could have chosen either real estate or equities because the last 7 years, if you looked at last 7 years, residential real estate had done very badly. If you look at office space, it is always much more difficult to invest in office space. But I would say office space had done badly from 2020 to 24, primarily because people started working from home in America. Due to that, office space had started to do badly. So the last 4 years, between equity, gold and silver, office space turned out to be the worst performing asset class, which is why office space turned out to be one of the best areas for asset allocation.
In fact, I've come across a lot of people who have either started investing in gold and silver now or they plan to do it. So what would you say to someone who wants to now start investing in gold based on recent returns?
See, basically, you have to remember that we like a category like multi-asset because it has everything. But once you have a category like multi-asset, it means you somewhere do asset allocation only. So it becomes much easier. Otherwise, if you woke up to silver 2.5 years back and said, I am going to invest in silver, it would be great because silver had done very badly. But now people wake up to silver Now, does silver pay dividend? Answer is no. Does silver pay interest? Answer is no. Can you judge silver on the basis of PE? The answer is no. As I mentioned right at the start, what is the problem with investing is not arithmetic. So I can tell you all that, but silver can go up for the next 6 months, can go up for the next 1 year also, can go up for the next 2 years also. But asset allocation involves investing in asset classes which have done badly, but silver has done the best. Why are people attracted to silver? Because silver and gold have done so well. So if you plot gold against equity today, gold has done much better than equity. So people are fascinated by gold because of that reason. Let's say gold has done very badly, and then people say, I want to invest in gold. We would not be opposed to it. But otherwise, now we tell people gold and silver only makes sense within a multi-asset framework. Multi-asset, you do automatic asset allocation and you don't invest too much in gold and silver. So it is fine. But otherwise, we are very worried when people suddenly wake up one day and say, I want to invest in a gold ETF, want to invest in a silver ETF. Because somewhere they are practicing what I call anti-asset allocation, which means that they invest in an asset class after it has done too well. That I call anti-asset allocation. And anti-asset allocation normally leads to disaster in the long run, not in the short run. In the short run, I could be proved wrong. And we at ICICI could be proved wrong. But in the long run, anti-asset allocation leads you to disaster.
So, talking about decisions, there's one framework that you follow. I'm talking about Michael Maubussin's pre-mortem technique for decision making. Can you explain us how to use it?
See, most of the time, no, whether it is in organizations, whether it is following an accident, whether it is following any negative event, people do what is called as a postmortem. So what you do in postmortem is identify who's responsible for the problem, who's responsible for the failure. It is just finger pointing at a negative person. What Michael Mauboussin said is, don't do that. If you know an election is coming, if you know a particular summit is going to happen, if you know something is going to happen, think before it. What's going to happen? And you know an election is coming. Let's say a US election. You know an Indian election is coming. You know a budget is coming. You know a GST council meeting is coming. What Michael Mauboussin says is do a pre-mortem, which means call all the people involved and say, what if GST council does this? What if GST council does that? And then analyze and say, probabilistically, GST council will do this. Probabilistically, election will do this. Probabilistically, this is what will happen in US election. Probabilistically, this is what will be done in the Fed meeting. Then what happens? You are not doing any finger pointing at anyone. So you get a very, very good quality decision. Because there's no finger pointing done at anyone. You are doing a decision. You are taking a decision in a good mind environment. The environment is very positive. No one is criticizing anyone. You are taking a decision in a good environment. Ahead of a budget, you say, okay, what will come in a budget? And you do it probabilistically. There is nothing deterministic because you don't know what will come in the budget. You take a call, 20% chance of an income tax cut, 10% chance of an income tax rise, 5% chance that this is what will be done in STT. Something like that, on that basis you take these calls. And therefore it leads you to much better decision making. Because the decision is taken in a very, very good environment. And therefore it leads you to very good decision. This is something I learned from Michael Mauboussin. And we at ICICI have used it significantly over the years. And we have found that it leads you to a much better working environment between all of us in the team. Because we are not searching for people who caused errors. We are searching for people who can think ahead of an event rather than for people who have made mistakes.
So, one thing that really also fascinates me is the checklist that you've spoken about, I think you draw that inspiration from Atul Gawande's checklist manifesto. So just wanted to understand how a checklist can help investor take better decisions, and and how do you implement it in your day-to-day working?
See, as you know, Dr. Atul Gawande wrote this about it based on airport pilot takeoffs and landings, and the fact that there are very few crashes in landings or in takeoffs is primarily because of the rigorous use of checklists. In investing, and I'm talking more at the level of individual investors. So if you put simple norms like I will invest if dividend yield is above 4%, if market goes down 40% in a year, I will buy aggressively. If the market goes up 60% in a year, I will sell aggressively. And if I double my money in a stock, I will reduce my position by 50%. These kind of checklists itself will actually improve the quality of a decision of most retail investors actually. And as I mentioned in the beginning, what we have learned is that investing is something which is not arithmetic, and therefore even improving the quality of decisions to a reasonable extent leads you to a good situation. So this whole concept of using simple checklists, and it is important not to have 10-page checklists. It is important to have a checklist where you have only 10 points. So you can have a simple checklist that never will I take an investment decision on the phone while talking to the stockbroker, and never will I take a decision instantly. These kind of simple 10-point checklists can lead you to improved decision making for a retail investor, and lead to a very good situation from a retail investor. At the level of ICICI Prudential investment team, the kind of checklists and the kind of frameworks that we need is much, much more complicated, because we can't make we can't make as many mistakes as a retail investor, and we are managing public money. So the level of rigor that is required in the process that we need at ICICI Prudential Mutual Fund is very different from what a retail investor can have. And therefore, the checklist and the process that is required at ICICI Prudential is more rigorous, and can be more complicated than what it can be at the level of a retail investor. Does not mean that ICICI Prudential Mutual Fund won't make mistakes. And in our opinion, even legends like Warren Buffett has made investing mistakes. But the quality of the checklist or the quality of the process will be much more deep than what a retail investor can.
Got it. And I think a supplementary framework along with checklist is also journaling, right? That you have also spoken about in the past. So when you talk about journaling, what exactly should an investor enter in his or her journal, and what are the kind of benefits they can draw out of it? Is it more of a, let's say, rationale for investing in some place and then going back and checking that whether I was right or wrong, or is it something more than that?
Even that is enough. If you look at retail investors, and I've spent 10 years as a stockbroker, and in the job that we do at ICICI Prudential, we get to meet a number of distributors, mutual fund distributors, and a number of investors. I think even a simple journal where you record 5 lines on why you take an investment or a disinvestment decision is enough. I think even that kind of a journaling, if people do, I think it will lead to dramatic improvement in their investment performance over their lifetime. Actually, to sum up, as I was preparing for this podcast, I would say that, investing is not arithmetic. It is a work in progress on a continuing basis for everyone. So I call it WIP. What does W stands for? It stands for writing, which
Okay.
is like journaling. I would say I is introspection, which means that you periodically introspect as to what you have done in investing till today, from the time you started investing. If you ask me, uh, P is, I would say, pre-mortem, because on a continuing basis, doing pre-mortem is very, very useful to you. And second, as most of us know, one of the best inventions for modern world has been AC, because it has helped to improve our life. So I would say A stands for asset allocation. And in my opinion, C stands for both checklist and cycles. Because end of the day, because if you recognize that you are in a down cycle and you want to invest, you normally make money. And on the other hand, if you are in a big up cycle, it is wise to be careful. So I would say investing is always work in progress, because you can never be an expert, because even Warren Buffett has made multiple mistakes. So, and W is writing, I is introspection, P is pre-mortem, A is asset allocation, C is checklist and cycles.
That's a really, really nice framework and very easy to remember.
Yes, thank you.
So, moving on to the next question, most of the conversation that happen dominates buying stocks or mutual funds. Rarely people talk about selling, and nobody talks about sizing. So, I just wanted to understand your philosophy around sizing. And while you explain that to our audience, do also talk about the switching framework when someone sells an investment.
See, when people buy a house, it is always a sizing decision, because you're putting a lot of money. So when you buy a house, you do a lot of work. Why? Because uh, you actually end up investing a lot of money. So it's a sizing decision automatically, because no house in India comes for a small amount of money. So it is an automatically. So what you do is you do a lot of work. You find out whether you like the locality, you like the entire building. How do you find the entire location? Whether you think going to, suppose you're working from there to office is comfortable. Is it comfortable for your children to go to school? Are there good medical facilities? You do all the work for sizing. On the other hand, in investing, just because it is easy to sell, what people do is what I call create a zoo, which means that they buy 100 companies. Then what they do is they don't do the work. So, I think it was either Warren Buffett or someone who said, buy only 20 stocks in a lifetime. So if you were to do that, what will happen is you'll do a lot of work, like buying a house. No one buys 20 houses in a lifetime. So then what will happen is you'll do a lot of work. You'll do the work that you do when you buy a house. Then automatically the quality of decision making improves, and the amount of money that you put becomes increases. Once the quality of the decision improves and the amount of money that you put into that decision is higher, you have a better investment. On the other hand, you invest in every IPO which comes, end up having 100 stocks in your portfolio. Together, that 100 stock cannot give you a better experience than any mutual fund or a index fund, because finally you've got a zoo. So that is why it's important to size, that you do the work, do more and more work on the company where you're putting more money, or more and more work on the fund that you're investing, and then you will have a better investing experience. On the selling, I think selling is a very tough decision, because every selling decision involves a tax implication normally. And on top of it, selling is a very emotional decision, because once you've bought something, you find selling emotionally difficult decision to sell. So that's why, at some point of time, one of the persons whom I used to know well said that the day you say I'm selling, you'll never do a proper decision. Convert it to switch. And once you say you're doing a switching, you find that the quality of the decision improves. And it's much better. Suppose you were to say, I'm selling all these shares to buy a house also. Sometimes it becomes much easier to take that decision. Or you say, I'm going to sell all these sector stocks to buy another sector because I like that sector over this. Then you don't get too worried about it. You're taking a call that sector A is better than sector B. And you don't over worry. Otherwise, you get so emotionally attached to that selling decision that it always hurts you. And that is why I believe, and I think there's too much of time spent on how to buy and very little time spent on sizing and selling stroke stitching. And this is what I've seen across over my entire career at ICICI Prudential and before. This is what we have seen, and that is why we keep talking about it.
The way you explained it, especially that concept of switching, is very fascinating. And that was, when I heard it for the first time from you, that was like a very aha moment. That acha, haan, this is also something, a way to think about selling. We are talking about taking structured decisions. And you also have another framework, which is TED or TDE, as you explain, which helps to bring structure to decision making. So can you elaborate on how it works in practice?
No, finally, it is, I would say, WIPAC reflects everything.
Okay.
Finally, thinking is what? Between pre-mortem. What is thinking? Pre-mortem is part of thinking. Checklist is part of the thinking process. TED is executing is again sizing. What we discussed is part of sizing. So if you look at it, if you look at the problem is that many people they keep thinking. They think for 3 years. By the time the bull market has already happened. So what we realize is that you have to, this entire concept is you have to execute. There's no point in only thinking. You have to execute and decide. And there are people who just keep on doing research and not deciding. That is why. But I would say WIPAC is more comprehensive because it covers almost everything we are talking. At the lower level, I would say it is finally everything is about thinking. Everything is about executing and deciding. But I would say we have created a more higher level process, which is what WIPAC is about.
Okay. So, finally, one last question, and I think what we have discussed so far was either about overall portfolio or specific to equity. One thing about debt that I also found quite fascinating was your SLR framework, which is safety, liquidity, and returns. Can you walk us through how do someone use it when including debt in their portfolio?
See, what happens is typically, equity delivers better returns than debt in the long run. So, at the same time, if you think about it, when you invest in debt, if you invest in debt, you should actually have safety, liquidity, and then return. So if you have safety and liquidity, for example, if you take a person like Warren Buffett, he's built a huge cash component. But why does he need? You think, why should he keep cash? Because there is no better asset class than cash. As a funding agency, when he needs the money, in 2008, he had the cash to invest and he used it. So there's no better asset class than debt. But at that point of time, assume that he was sitting in some mortgage-backed security. It wouldn't have helped. He was sitting in safe securities and he was sitting in liquid securities. So he could sell that and put that money in equity in 2008. So the purpose of debt is that you have to actually have that money liquid and you should be safe so that you are able to get that money in safety and liquidity. If you have, then the return actually comes from the other asset classes. But if you don't have debt, it's a big crisis because debt is the asset class which helps you to make money in other asset classes. So there will be a time real estate comes down. There'll be a time equity comes down. But for all those asset classes to be able to use the opportunity, you need money in debt. And for that, you should have money in safe debt and also liquid debt. If you don't have money in safe debt and liquid debt, there's no use. Return is not important. Return will always be lower than equity. But doesn't mean debt is not important. Debt is supremely important, but it should be used. It should be both safe and liquid so that you can use it to buy the other asset classes as and when the other asset classes crash.
In fact, I want to ask you one question about what you just spoke. So, at ICICI Prudential's level, do you follow this whole practice of sitting in cash? I mean, if you don't find good opportunities, would you rather prefer to sit a bit in cash than be invested all the time?
So, over the last 20 months, most of my colleagues, most of the mutual fund distributors, most of the mass media have got bored hearing from me that you should do asset allocation. What does asset allocation mean? It means invest in debt also. And if you look at the kind of categories we have actually told people to invest in, it is categories like balanced advantage, equity and debt, multi-asset, equity savings categories. If you look at the underlying of those categories, it involves so much of debt and cash in those categories. So typically, these categories have had a lot of debt. And those actually, if you look at it, those categories have actually given a very good investing experience because the markets have been volatile in the last 18 months. It is only in the last 1 month or so it appears that India has become much more contrarian. If I look at it, I would say that only now in September 2025, I would say India has become contrarian because all other asset classes have done so well. But otherwise, we used to think India has done very well against the world. But if you look at it, debt has played a huge role in actually delivering a good investor experience in all the hybrid categories in the market.
True, true. In fact, I recently compared the past 1 year returns of diversified equity and hybrid funds from ICICI Prudential. And to my surprise, the balance advantage and aggressive hybrid funds have done far better in this short duration. Thank you. Thank you so much, sir, for your time and joining us on this podcast. It was really, really fascinating talking to you.
My pleasure, and wish all the ET Money viewers a very, very happy Diwali and festive season ahead, and Dasara and Diwali and festive season ahead. And I really enjoyed the show because, it's not about what will happen to the markets in the next 10 days or 15 days. It's more about creating a process which allows them to overall make lesser mistakes and therefore give a chance to compound money over a longer period of time in the right way. And we at ICICI have always tried to focus our attention on that. And I would like to thank ET Money for giving us this opportunity. Thank you.
Thank you so much, sir.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.